We're diving deep into the world of beverage stocks. We're going to look at 5 major players in the beverage industry: Coca-Cola, PepsiCo, Monster Beverage, Keurig Dr Pepper, and Constellation Brands. We're going to see which ones are going to add a little bit of sparkle into your portfolio. Now, let's pop the cap on our first stock, Coca-Cola. Looking at the monthly chart, we can see a beautiful trend from 1989 to 1998. It climbed a whopping 1,260%. That's enough to make anyone's eyes pop. But since then, it's been a bit of a roller coaster. From 1998 to 2003, it declined by 60%, but then it formed a base until February 2011. That's when things got interesting again. March 2011 marked a breakout, and since then, it's climbed 112%. Not bad, but not as impressive as that initial run back in the 80s and 90s. Coca-Cola then reset its cycle. Phase 1 ran from 2011 to February 2020, climbing 83%, but it was a choppy ride. Not what we want as investors. We want smooth trends. Phase 2 is the consolidation period, or a sideways market, which lasted from February 2020 to July 2024. Phase 3 kicked off in August 2024 with a breakout and new all-time highs, and now we're waiting to see if Phase 4 will be confirmed. And again, what we really want to see is a smoother, more linear uptrend emerge, like we saw back in the 80s and 90s. On the weekly chart, Coca-Cola is trading above both the 50 weekly simple moving average and the 200 simple moving average. And our proprietary trend filter is green, which confirms that a new uptrend is in progress. The daily chart tells a similar story. It's above the 20-day, 50-day, and 200-day simple moving averages. Our trend filter again is green here too. This alignment between the weekly and the daily timeframes is a good sign that an uptrend is in play. So the question is, when's the right time to buy? Well, we want to avoid a fake breakout, and that's when the stock teases us by breaking out, only to fall back into phase 2, that sideways market. To avoid this, we wait for a pullback to retest the previous all-time high as an area of support and bounce off that support, and then the next breakout. Patience is key here. Okay, here's a pro tip. Use the 20-day SMA and the 50-day SMA on the daily chart to identify a linear trend. If the stock's price regularly moves through the 50-day simple moving average down to the 200-day simple moving average, you've got a very choppy stock in progress, and that means a bumpy ride, not what we want as investors. Okay, so the analysis I have just used is what we call our 4-phase sequence method, or the 4PS method for short, which breaks down like this. Phase 1 is identifying a stock with a proven performance history. Phase 2 is waiting for a prolonged consolidation or base to form. Phase 3 is a confirmation of a breakout from that base. And Phase 4 is when we enter the stock at the start of the next major uptrend. Okay, next up, we've got PepsiCo, which went public back in 1965 at just 75 cents a share. Since then, it's gone through 4 stock splits and is now trading around $175 a share. It's been a very good earner for long-term investors, but like any relationship, it's required patience. There have been some deep declines along the way. Looking at the monthly chart, Phase 1 ran from 2013 to May 2023, climbing 147%. Not too shabby at all. It has been trading inside a Phase 2 consolidation since its all-time high last year. We're still waiting for that Phase 3 breakout, and that will be signaled by a move out of Phase 2 and new all-time highs. And Phase 4 is when we look to enter our first positions and then compound as the trend develops. Okay, the weekly chart shows that PepsiCo is trading above both the 50-week and 200-week SMAs. Our trend filter is green, suggesting an uptrend. The daily chart mirrors exactly what we see on the weekly chart, and that is that PepsiCo is trading above the 20-day, the 50-day, and the 200 SMAs. The trend filter is green here too. Again, we've got that nice alignment between the 2 timeframes. So when should you be buying PepsiCo? Well, you've got 2 options. An aggressive entry would be a break and close above the resistance level of May 2024. This could mean more profit if it breaks out and hits new all-time highs. But the risk of entering early is that it could remain stuck in this Phase 2 consolidation. A conservative entry would be a wait for a breakout, new all-time highs, and then follow the same setup that I explained on Coca-Cola, which is a breakout, a pullback, and then the next breakout. Remember, the 4PS method is all about identifying these phases and making informed, objective decisions based on these phases. Also remember that standing aside is also a position. Okay, next up is Monster Beverage. Monster went public on August 18th, 1995 at a split adjusted price of just 1 cent per share. Today, it's trading at $52 a share. Not bad at all. But here's the thing. While it's been a good earner for long-term investors, it's been a wild ride. There have been deep declines and choppy trend structures along the way. Looking at the monthly chart, it's very difficult for us to apply our 4PS method. Monster tends to move in blocks, which isn't ideal. We prefer to see smooth linear trends followed by a period of consolidation, then another smooth linear trend, and then that consolidation to repeat, and so on and so forth. Right now, Monster is stuck in one of those blocks. The weekly chart shows Monster above the 200 simple moving average, which suggests a bullish bias. However, our trend filter is grey, indicating no clear trend direction at the moment. The daily chart paints a different picture. Monster is below the 200-day simple moving average, which typically signals a bearish bias and further weakness. But here's where it's getting interesting. Our trend filter has turned green in recent days. This could be the start of a move up. So the question then is, when's the right time to buy, given that we have a mixture of bullish and bearish factors? Well, we need to see alignment across all timeframes. We want to see Monster trading above all the moving averages on the weekly and the daily timeframes, and we want our proprietary trend filter to be green on both timeframes. We'd also want to see a breakout and new all-time high. So you can really see how some patience is needed here for Monster to come good. But here's the thing, based on its history, Monster is likely to be a long, choppy ride ahead. It's certainly not at the top of our beverage stocks list. Okay, here's another pro tip. Think of the weekly as big sister and the daily as little sister. Whatever big sister is doing, we want little sister to be following. This is what we call alignment. If the two time frames are aligned, we have a trend in play that could be either bullish or bearish. If they are not aligned, then there is some kind of disconnect, potentially a pullback or a correction in play. Next up, we've got Keurig Dr. Pepper, which was established in 2018 following a merger between Keurig Green Mountain Coffee and Dr. Pepper Snapple. Looking at the monthly chart, Phase 1 ran from the 2009 low to the November 2019 high. This was a beautiful trend, climbing 1,560%. Since the COVID-19 pandemic hit, KDP has been stuck in a Phase 2 consolidation. We're still waiting for Phase 3, which will be signaled by a move out of Phase 2 and new all-time highs. Phase 4 is when we'd look to enter positions once it has been confirmed. The weekly chart shows Dr. Pepper trading above both the 50 and 200 simple moving averages, and our trend filter is green, suggesting an uptrend is in progress. The daily chart tells a similar story. Dr. Pepper is above the 20-day, the 50-day, and the 200-day simple moving averages. The trend filter is green here too. This alignment between the time frames is an early sign that an uptrend might be forming. Okay, so again, the question is, when should you buy Dr. Pepper? Well, it's just closed back above the weekly 200-day simple moving average, and the daily 20-day simple moving average hasn't yet moved above the 50-day simple moving average. This tells us it's still a bit early to enter. The time frames are still aligning. We do not have that confirmation. An early entry would be a break and close above last year's high. This could mean more profit if it breaks out and hits new all-time highs, but remember, there's always a risk it could remain inside Phase 2 consolidation. A more conservative approach would be to wait for a breakout, new all-time highs, and then follow the same setup I explained for Coca-Cola and PepsiCo, which is a breakout, pullback, and then the next breakout. Last, but certainly not least, we've got Constellation Brands. Now, this might not be a household name like Coca-Cola or Pepsi, but let me tell you this stock is arguably the most appealing of the bunch. STZ went public way back in 1973. It changed its name to Constellation Brands in September 2000. Looking at the monthly chart, Phase 1 ran from August 2012 to April 2018. This was an investor's dream, a clean linear trend structure with no wild swings. It climbed 707%. Since then, STZ has been trading inside a Phase 2 consolidation, that sideways market. We're still waiting for Phase 3, which will be signaled by a move out of Phase 2 and new all-time highs. Phase 4 is when we look to enter positions once that new uptrend has been confirmed. Okay, the weekly chart shows STZ trading above the 200 weekly simple moving average, which confirms an overall bullish bias. However, it's below the 50 weekly simple moving average, and our proprietary trend filter is alternating between green, grey, and red. This confirms we are still stuck in a flat phase 2 market. The daily chart shows STZ swinging above and below all 3 moving averages. The moving averages themselves are flat, further confirming we're in phase 2 and that sideways market. So the question again is, when's the right time to buy STZ? Given how flat this stock currently is, we're going to wait for a breakout from phase 2 and new all-time highs. This stock has huge upside potential to trend, but we need to see it confirm a trend direction before taking positions. Entering now would mean being stuck in phase 2 for a potentially lengthy period of time with no return on your capital. You'd be better off putting that risk into other stocks that are already in phase 4, that are already in their uptrend. Out of all of these stocks, Coca-Cola and Constellation Brands are our top picks. Now that you know what beverage stocks have the potential to sparkle or remain flat, diversifying into other sectors is essential to consistently grow your portfolio. Watch this next video where I cover big tech that have historically delivered excellent returns.